Welcome to our lecture series on financial management. Today we will talk about price versus value. One of the most important and most misunderstood concepts in financial portfolio management is the distinction between price and value. Although they are often used interchangeably in everyday language, price and value represent fundamentally different ideas in finance. Understanding the difference between price and value is essential for making sound investment decisions, managing portfolios, and avoiding emotionally driven mistakes. Price is what you pay for an asset in the market at a given moment, determined by supply and demand. Key characteristics of price include: it is observed directly in financial markets, it changes continuously throughout the trading day, it is influenced by news, emotions, expectations, and liquidity, and it may deviate significantly from underlying value. For instance, a stock trading at $50 at 10:00 a.m. and $48 at 10:01 a.m. shows only a price change, not a fundamental shift in the company. Price reflects what the marginal buyer and seller agree upon at that moment, not the long-term worth of the business. Value, however, refers to the intrinsic worth of an asset based on its ability to generate future cash flows. Key characteristics of value include: it is grounded in fundamentals such as earnings, cash flow, and growth. It changes slowly over time. It depends on long-term expectations, and it is not directly observable, and it must be estimated. Unlike price, value must be estimated and changes slowly over time depending on long-term expectations. For example, the value of a rental property depends on expected rental income, maintenance costs, location, and long-term demand. The market price of the property may fluctuate, but its value is driven by its income-generating ability. Prices change frequently because markets constantly process new information, opinions, and emotions. Common drivers of short-term price changes include news headlines, earnings announcements, interest rate changes, market sentiment, and speculation and momentum trading. Yet, these short-term factors typically do not immediately alter a company's long-term cash flows, meaning value remains stable. Key insight here is that price is noisy, value is stable. Stock prices fluctuate constantly because they are determined in liquid markets where trades occur every second. Reasons for frequent price movements include millions of participants with different beliefs, short-term trading strategies, algorithmic and high-frequency trading, and emotional reactions to information. In contrast, a company's value depends on long-term profitability, business model sustainability, competitive advantages, and management quality. These factors evolve gradually, not minute by minute. Think of stock prices as the constantly moving surface of the ocean, while value is the stable, slow-to-change depth of the ocean. Meme stocks, like GameStop or AMC Entertainment during their surges, powerfully illustrate this difference. Characteristics of meme stocks include rapid price increases, heavy retail investor participation, strong influence of social media narratives, and limited connection to fundamentals. Their prices rose dramatically due to social media influence and coordinated behavior, despite weak fundamentals like declining revenues or high debt. This shows that price can be driven by perception and narrative, even when underlying value remains weak. The distinction between value and growth stocks highlights different relationships between price and value. Value stocks trade at low prices relative to fundamentals and may be temporarily undervalued, often being mature companies. Growth stocks, conversely, trade at high prices relative to current earnings, with investors expecting rapid future growth and often reinvest profits, if they have any, instead of paying dividends. Perception plays a major role in determining market prices. Sources of perception include media coverage, analyst opinions, social media narratives, and investor psychology. Common perception-driven behaviors include fear of missing out, herd behavior, and overreaction to news, pushing prices far from intrinsic value. Over long horizons, prices tend to move toward intrinsic value, aligning with the principle that markets are weighing machines in the long run. In the short run, however, markets act as voting machines, driven by speculation and noise. In the long run, markets are weighing machines. Investors focusing on value avoid speculative bubbles, manage risk effectively, and achieve sustainable returns. Common mistakes include believing a rising price implies increasing value or assuming a falling price means a bad company. These errors, along with chasing popular stocks without understanding fundamentals or ignoring valuation during speculative periods, often lead to poor portfolio performance. Therefore, prioritizing value over price volatility is essential for long-term investment success and avoiding short-term traps. Remember, long-term success comes from fundamentals, not market noise. Thank you for watching our lecture on financial management focusing on price versus value. See you at the next lecture.